Chart patterns put all the buying and selling in the stock market into a concise picture. So, if you're able to identify these patterns early, they'll help you to gain a real advantage in the market. That's why today we're going to take a look at the 10 most essential chart patterns that you should know when trading in the stock market. Stay tuned. Welcome to the NAV Millionaires Club, everybody. Here, we provide updated news and articles about financial markets and business strategies. So, if you're new here, make sure to subscribe to our channel and tap on the bell icon, so you'll be notified of all new videos here. Now, let's see what we're having for today. 10 most essential chart patterns every stock trader needs to know. Number 1. Head and shoulders. This is actually a bullish and bearish reversal pattern that has a high peak in the middle and shorter peaks on either side. This pattern is regarded as one of the most reliable reversal chart patterns. It's formed when a stock's price rises to a peak and then falls down to the point where it first began to rise. Here, once more, the price rises, reaching a peak that is higher than the previous one and again falls to the original base. Now, the price rises again to form a third peak, which is lower than the second one, and from here, it begins falling to the base level. Once the price breaks the baseline, the bearish reversal takes place. Number 2. Double top. This one is basically another bearish reversal pattern. In this pattern, the price of the stock will peak before falling to a level of support. It will then form another peak before reversing back from the prevailing trend. Number 3. Double bottom. This is a bullish reversal pattern that is completely opposite of the double top. In this pattern, the stock price forms a peak and then retraces back to a level of resistance. It will then form another peak before reversing back from the prevailing trend. Number 4. Cup and handle. This is a bullish reversal chart pattern that looks like a cup and a handle, where the cup is shaped like a U, and the handle has a small downward drift. The cup and the handle resemble a rounding bottom chart pattern and a wedge pattern, respectively. Essentially, the right side of the pattern has a low trading volume that might be as short as 7 weeks or as long as 65 weeks. Number 5. Rounding bottom. Rounding bottom, aka saucer bottom, is a long-term reversal chart pattern. It shows that the stock's downward trend is changing to an upward one. It can actually take any time, from a few months to years, to form. Rounding bottom is similar to the cup and handle pattern, but there is a significant difference between them. It has no handle. Number 6. Wedges. Wedges are bullish and bearish reversal patterns as well as continuation patterns that are shaped by joining two trend lines that converge. It can be a rising or a falling wedge. A rising wedge happens when the price of the stock increases over time, whereas a falling wedge happens when the price of the stock decreases over time. Wedge patterns could be drawn by utilizing trend lines and connecting the peaks and the troughs. Once a price breakout occurs, there will be a sharp movement in either direction. Number 7. Pennants. A pennant pattern is formed when there's a sharp movement in the stock either in the upward or downward direction. This is followed by a phase of consolidation that forms the pennant shape because of the converging lines. After that, a breakout movement happens in the same direction as the big stock move. This pattern is similar to the flag pattern and often lasts between 1 and 3 weeks. At the initial stock movement, there's a big volume that is followed by a weaker volume in the pennant area. Afterward, at the breakout, you will see a rise in the volume again. Number 8. Symmetrical triangles. Symmetrical triangles could be bullish or bearish continuation chart patterns developed by two trend lines that converge. These trend lines connect the peaks and troughs and occur in the direction of the ongoing trend. Number 9. Ascending triangles. You can see this triangle, which is basically a bullish continuation pattern during an upward trend. Sometimes it can also be formed at the end of a downward trend as a reversal pattern. However, it's more commonly known as a continuation chart pattern. These triangles are always classified as bullish patterns whenever they are seen on the charts. Number 10. Descending triangles. Similar to the ascending triangle, the descending one is also a continuation chart pattern. However, it's a bearish continuation pattern and is formed during the downtrend. Sometimes it can also be formed at the end of an uptrend as a reversal pattern. However, it's more commonly regarded as a continuation chart pattern. Alright, that's all for today. Please, never hesitate to subscribe to our channel and like this video because your support means a lot to us, and it will give us the strength to prepare many more videos. And now, what other chart patterns do you know or have heard of? Make sure to share what you know in the comment section below.